Hello guys, welcome to another video. Today we are going to talk about property, plant and equipment. Actually, the property, plant and equipment are our fixed asset. Fixed asset means to say they provide us the benefit from their use in the production of goods or services, not from their consumption. So we have 4 points relevant to the property, plant and equipment. The first of all, the property, plant and equipment are tangible assets. Tangible asset means to say they have physical existence. And secondly, the property, plant and equipment could be your personal property. Personal property means something which is movable like equipment, or it could be a real property such as land and building. So the property, plant and equipment are used in the ordinary operation of the entity, and these are not held for the purpose of investment, resale, or maybe in the inclusion in any other product. Okay, but you might sold these property, plant and equipment. So these assets are non-current in nature. Non-current in nature means that these assets are going to provide us the benefit over many years. So that is why this is called property, plant and equipment. So here we have types of property, plant and equipment. So your PPE can include land and building. It might also include land improvements like such as landscaping, drainage system, maybe streets, street lighting, maybe sewers, sidewalks, parking lots, driveways, and fences. So these are called land improvements. Then you have a machinery and equipment, like for example, it might also include the furniture, fixtures, personal property which is movable, maybe the permanently attached real property such as central heating system and vehicles. So it also include leasehold improvements. Leasehold improvement mean to say sometime maybe you might have a land on lease, and maybe you are going to construct a building on the leased land. So that is called leasehold improvements. Then it might also include internally constructed asset, which we will cover in the separate video because its accounting is little bit different. And then it might also include the miscellaneous item such as tools, patrons, dies. These are called your types of property, plant and equipment. So here we have how to calculate the carrying amount of the property, plant and equipment. I mean, say how we can show these PPE in our balance sheet. We always record at historic cost. We will talk about what will be included in the historic cost, less any accumulated depreciation if we have calculated. So less you will subtract any impairment losses. We will talk about what is impairment loss. Actually, it is the permanent reduction in the value of asset, but not due to the use. Okay, so this is how you got the asset carrying value, which you will report in the balance sheet. So here we have now general rule, like we are going to talk about what will be included in historical or initial cost of the asset. So here we have a general rule to capitalize the cost. So PPE are initially measured at historic cost, means say at the time of purchase, you will record the asset, like you will pass debit asset, okay, credit cash with the historic cost. And the historical cost might include three types of cost overall. It might include the amount paid to acquire the asset, such as maybe the purchase price, including import duties and non-refundable taxes. Okay, if you have paid any taxes which is refundable, please note that should not be the part of cost of asset. Okay, so it might, you also need to deduct any trade discount and rebates. This is what is the amount paid to acquire the asset. Then second thing, it might include all the cost needed to bring the asset to the present condition or location. So these costs might include freight in, installation cost, renovation cost, reconditioning cost. Okay, it might also include the expenses of test and trial runs. It might also include the insurance cost, but until the date of asset, until the date when the asset is ready for use. Okay, it might also include taxes during the pre-operation of the period. So this is what is the general rule. And the third point, which will be the part of the cost of asset, that is the cost of dismantling and removing the item. Maybe if you have installed the plant or machinery, maybe at the end of the useful life, you need to restore the land. So you will incur certain costs. So those costs will also be the part of cost of asset. And this will also be covered in a separate video, because these usually cost we capitalize. We need to calculate the present values, because we will pay after certain time period. So we will cover in a separate topic. So here we have a summary what we learned here till now. So like what will be the part of the historic cost? Historic cost will include the cost of purchase, less discount or rebate. We will add non-refundable taxes like import duties. We will also add legal cost, etc. If you have paid, we will also add site preparation cost plus installation charges plus dismantling cost. But usually we calculate the present value of dismantling cost to capitalize it. And then delivery and handling cost, cost of testing and trial runs. It might also include the interest or the borrowing cost to acquire or construct the asset. For this, we will also cover in a separate video how to capitalize the interest cost. This is how you will get the total cost, which is also called historic cost. Let's assume this is $1,000 for the sake of question. So just what we will need to do here, we will debit the asset and credit the cash with $1,000. This is what is called initial measurement. Then here we have few notes. Please remember, historic cost we will adjust for the changes in utility over the life of asset. For example, depreciation, we will calculate the depreciation and impairment. And second one, you should remember, depreciation does not start until the PPE are placed in operation and that begins to contribute economic benefit. The third point which you should remember, under GAAP, we will not revalue our assets. We don't have any revaluation model. We will record our asset only on historic cost. This is rule for US GAAP. But under IFRS, later on in the subsequent measurement, you can record the asset at cost or at market values. I mean, say you can use the revaluation model there under IFRS. But under US GAAP, you have to use only cost model, which we will go through how these method will work. Okay. So here we have a very important topic now. We are going to talk about uh, initial cost for land. Like if you are going to buy a land, what will be the part of cost of land? Okay. So first thing, it might include the purchase price, okay, which you are going to pay to the seller. That will be the part of cost of land. It will also include any encumbrances assumed. Encumbrances assumed mean to say maybe that the land which you are going to buy, that is already the seller is having a loan on that. Maybe you are going to take a responsibility of the loan, that is called mortgages. So if you are going to take any responsibility of such kind of loans which you will pay, so it will be the part of cost of asset. It might also include any tax liens. Okay. Then the cost of land also include the transaction cost. Transaction cost mean to say surveying cost, legal fees, brokers commission, title insurance, and maybe some escrow fees also. Escrow fees maybe you hired a company who will prepare your deed, okay, some paperwork. So you are going to pay some certain cost for those paperwork. So that will also be capitalized. I would say it will be the part of cost of land. Then it might also include the site preparation cost. Site preparation cost means say clearing the land, maybe draining system, filling the land, or leveling the property. even raising existing building. Maybe if you purchase the land and there is an old building there and that you don't need, maybe you are going to demolish that building. So the cost which you have incurred to demolish the building, that will also be the part of cost of land. So here we have a very important note, minus any proceed which you will get through the sale of timber. I mean, so there might be certain trees, okay, which you will sell maybe, okay, and you will get certain inflows for that. So this sale of timber will always reduce the cost of lands. I will show you with the help of example, okay. You will not record these sale of the revenue from the sale of timber as a revenue. No, you will reduce the cost of the land. So then you might have certain permanent improvements for the land. Permanent improvement, maybe you have a sidewalks or the maybe something like that. So, but those improvements have indefinite life. If this is the case, so the cost of those land improvements we will also debit it to the land account. Okay, and land is always is having a indefinite life, so that is why we will never depreciate the land. So here we have another note. Please remember, if you made any permanent improvements, but those permanent improvements might have, I mean say land improvements, they might have a finite useful life, then what you need to do, you need to record as a separate asset. Okay, and this separate asset you need to depreciate over its useful life. For example, maybe you are going to construct a parking lot, okay, and the parking lot is having a finite life, and of course, maybe after certain number of years, you have to repaint the parking lines, etc. So that all this cost, which is land improvement, because it has finite life, it should be recorded as separate asset and it must be depreciated. Okay. Here we have a small example. For example, we have acquired a land for $100,000. We incurred certain legal cost for the land title of 5,000. We have certain trees on land which were sold later for $1,000. So the question is that what cost should be capitalized? I mean, this is the part of asset. So here what you will do, you will take the cost of purchase, which is $100,000 plus legal cost, which is $5,000. So your total storage cost is 105,000. Now you will less from here this revenue from the sale of timber, because it is going to reduce your cost of land. It means your net cost of land is 104,000. So, but if you have sold later, what you can do? So today you can pass the entry with the initial cost, like debit land account and credit cash account, what with 105,000. And later once we will sell the timber, so at that time what entry you can pass debit cash account with 1,000 and credit land account with 1,000. So this is how your land will be reflected at net value, because initially you have recorded land by 105,000 and later on you have credited the land by 1,000. So automatically your land will be reflected at 104,000, which will be the net cost of the land. Okay. Then we have a initial capitalization issue for the building. Please remember. So whatever the cost you will incur to acquire the building, that should be capitalized, and those costs might include the purchase price, including any tax liens, or okay, it might also include the cost of renovating and preparing the structure for the expected use. So this cost also should be capitalized. And it might also include the expense of excavating the site to build the foundation, but not the site preparation cost. Like you should remember, the site preparation cost, like the leveling, etc., it will go to the cost of land account. But if you want to construct a building, the time when you will start the construction of the foundation, okay, you are going to build the foundation of the building, the cost of the foundation will be the cost of building account, not to the land account. Okay, but site preparation cost should go to the land account. So then when you construct the building, you will also incur certain cost of material, labor, and overhead. So these costs will also be the part of cost of building. And then you might also have a interest cost which you have incurred during the construction of the building for the entity's own use. That interest cost should also be capitalized. So here we have here initial cost for the leasehold improvements. Now, leasehold improvement means say maybe you have a piece of land on lease and you are going to construct a building on the leased land. So that is called leasehold improvements. Okay. And leasehold improvements are accounted for by the lessee in the same way as the property to which title is held. Like it is treated as the same way if you own the asset, but the problem comes always with that depreciation period. Like what should be that depreciation period? Because your lease period might be different than the asset life. For example, you have taken a land on lease for 20 years, but you have constructed a building on that which is having a life of 30 years. Now the question is that the building which you want to depreciate, how many years we should use to depreciate. So here we have a rule. So depreciation period, if you want to select, you always need to take a shorter of useful life of the asset. For example, I'm assuming let's assume useful life of the asset in the building is 30 years, and the B is what remaining lease term. For example, remaining lease term is 20 years. Here you can see we have a one more part which will include the part or the full renewal period of the lease if certain. What it is actually, for example, you have taken a land on lease for 20 years. Okay, but here you have a option to renew this lease. Okay, maybe for further, let's assume 15 years, and as a lessee you are certain that you are going to renew it for further 15 years. If you are certain, so it means today you will say the lease term is 20 years plus 15 years is equal to 35 years. But if you are not certain to renew the land lease, then you should take only 20 years. Okay, this is what we are going to do here. So you have to take shorter of useful life or remaining lease term plus part or full renewal period if certain. If renewal is not certain, then take only remaining lease period, which is 20 years. So here we have a question. Let's practice the question, what we learned here. So they're telling you during January, Yana company incurred landscaping cost of $120,000 to improve leased property. Okay, so it's a leasehold improvements. The estimated useful life of the landscaping is 15 years. This is your useful life, and useful life is 15 years. The remaining term of the lease is 8 years. So we have a lease term, okay, which is 8 years with an option to renew it. We have option to renew it, okay, for additional 4 years, but you have to check we are certain to renew it or not. However, Yana has not reached to decision with regard to the renewal option. It means it's not certain. So we will take only lease period is 8 years. Okay. In Yana, December 31st balance sheet, maybe it's just the first year. What should be the net carrying amount, okay, of landscaping cost? And you know the carrying amount, how you will calculate? You need a cost of asset. The cost is how much we have 120,000. From cost we will subtract accumulated depreciation. Then this is how you will get the carrying value. But to calculate the accumulated depreciation, you need to calculate first depreciation, and it's the first year. To calculate the depreciation, we can assume here we are using straight line method because only life is given. So what you will do, you will take the cost of asset, which is 120,000. There is no residual value, so you will put it here 0, divided by, you have to take the shorter of useful life, okay, which is 15 years, and lease life, which is 8 years. So the shorter period is 8 years. If you will depreciate over 8 years, so you will get depreciation expense of 15,000 per annum. So I am assuming it's the first year. So it means your cumulative depreciation will be only 15,000. So it means your carrying value of asset should be how much? 105,000. It means option B is the correct option. Okay. Then you have here another point. We are going to talk about now initial cost for machinery and equipment. Like what should be capitalized as a part of machinery and equipment. So of course, the cost will include what? Purchase price, including sale taxes, but these taxes should be non-refundable. Okay. Then what you have, you might include the freight in cost, handling cost, maybe loading, unloading, insurance cost, but insurance cost until the asset is ready for use only, okay? And storage cost also until the use begins. Then it might also include preparation cost, installation cost, startup cost, such as testing and trial runs. So here we have a small example to practice. So here we go. On January 1, year 1, an entity purchased a machine to be used in production. The machine was installed and ready for its intended use on July 1, year 1. This is the date when asset is ready for use. The following costs were incurred during year 1. We have a purchase price, 100,000. Of course, it should be capitalized. Here you have a year 1 insurance cost incurred evenly throughout the year. So actually this insurance cost 10,000 is for full year. And asset is ready for use at which date? On July 1, asset is ready for use. It means this insurance cost you paid for full year, but for the first 6 months the asset was not ready for use. It means those cost of the 6 month, okay, we can capitalize. For example, insurance cost was 10,000 total, so multiply by 6 over 12. If you will solve it, it means $5,000 you can capitalize. And from 1st January till 1st July, you can capitalize. And from July 1 till December 31st, the remaining 5,000 you will record as expense. Only it means the capitalized cost will be this 100,000. I mean, say this 100,000 plus you will capitalize 5,000 from insurance cost, plus you will also capitalize shipping cost, this one 3,000 also, plus installation cost also, plus testing cost also. If you will make the summation, this is going to give you $114,500. So this should be your capitalized cost. So here we have a small question to practice. So they are telling you Mary company purchased a machine costing 125,000 for its manufacturing operation and paid shipping cost of $20,000. So it's also capitalized and purchase price is also capitalized. The Mary spent an additional $10,000 on testing and preparing the machine for use. It means testing cost is also capitalized. What amount should Mary record as the cost of the machine? So it should include purchase price, which is 125,000, plus shipping cost, which is 20,000, plus testing cost, which is 10,000. The total is 155,000. So these costs should be capitalized. So it means answer A is correct answer. Then you have here another point. So now we are going to deal with the donated assets. Sometime maybe if you are a company, you might get some asset which is donated by some party, some other parties. So what you need to do, the rule is that the donated asset should be recorded as asset at the fair value, okay, at the market value, at the day when you receive this asset. So what entry you will pass? You will pass debit asset with the fair value and credit contribution revenue or other income you can recall. So this is what is the rule for donated asset. Now here we are going to talk about acquisition of group of assets. Okay, by maybe you have paid lump sum amount, but you purchased a group of assets. In that scenario, you need to allocate the lump sum amount to each individual asset based on standalone selling price. Okay, standalone selling price means based on their fair values. So here we go with the help of example. We will understand this one. My company paid a lump sum purchase price of $100,000 to acquire the following asset. We have acquired the asset, what building, machine, and inventory, and this is their fair values at the date of acquisition: 72,000 for building, 36,000 for machine, 12,000 for inventory. The total fair values are 120,000. But don't forget, we purchased as lump sum value, which is 100,000. Okay, so now what you will do, you need to allocate this $100,000 to the individual asset and based on their relative fair values. How we can do it? Here we go. For example, you have here asset acquired. Just put the name of asset, building, machine, inventory. Write their fair values. For the building, fair value is 72,000, which is given in the question. For machine, it is 36,000. For inventory, it is 12,000. And now you will just convert into the percentage. And don't forget, total fair value is 120,000. If I want to calculate for the building percentage, what I will do, I will take the value of the building, which is 72,000, divided by total value, which is 120,000. This is how you will get the 60%. Now, if I want to calculate the percentages for machine, what I will do, I will take the machine value 36,000 divided by 120,000. Okay, I will get the 30%. The same way, if you want to calculate for the inventory, I need inventory fair value divided by total value. So I will get 10%. Okay. Now, what you need to do, simply you will multiply 60%, because here is the first value is the 60%. You will multiply with the transaction price, and transaction cost was 100,000. Like if you will take 60% of 100,000, it means 60,000 should be allocated to the building. Same way for the machinery, what we need to do, we have a lump sum price $100,000, but machinery percentage is 30%. If you will get calculate, you will get $30,000. Okay, this should be allocated to machine, and the 10% should be allocated to the inventory. We have a transaction price of 100,000 and inventory fair value percentages are 10%. It means 10,000 should be allocated to the inventory. So now what entry you will pass? You should debit the building, okay, with how much? 60,000. Okay, you should debit the machine, okay, with the $30,000. These value I'm using, these value. Okay, and we will debit the maybe in inventory you have with the 10,000, and you will credit the cash by $100,000. This is how you will deal with the initial measurement, guys. See you in the next video. In the next video, I'm going to talk about capital and revenue expenditure, how to deal with the improvements, additions, substitutions. So see you in the next video. Thank you so much. Bye bye.